Today, we're breaking down HGER, the Harbor Commodity All-Weather Strategy ETF, a commodity-based ETF designed specifically to act as an inflation hedge. Unlike broad commodity ETFs that simply hold futures by size or liquidity, HGER uses a rules-based multi-factor approach to target commodities that are most sensitive to changes in U.S. inflation, as measured by CPI. HGER tracks an index designed to provide broad exposure to inflation-sensitive commodities, with both selection and weighting driven by fundamental and technical factors. The goal is not to speculate on a single commodity, but to efficiently diversify across multiple commodities that historically respond to inflationary pressures. The process begins with a universe of the 24 most liquid commodity futures contracts. These contracts are evaluated based on several criteria, including economic significance, open interest, trading liquidity, holding and roll costs, and sensitivity to inflation. This helps filter out contracts that may be inefficient, expensive to hold, or less relevant as inflation hedges. From that universe, the index selects at least 15 commodity futures to include in the portfolio. Individual commodity weights typically range from 2% to 20%, which helps prevent overconcentration in any single commodity. One notable exception is gold, which can be weighted as high as 40%, depending on the inflation regime. Gold plays a special role in HGER's strategy. The index uses a proprietary scarcity debasement indicator to determine the prevailing inflationary environment. Based on whether inflation is being driven by monetary debasement, supply constraints, or broader economic forces, the allocation to gold is adjusted accordingly. This allows the fund to dynamically scale gold exposure rather than holding a static allocation. The rest of the portfolio is spread across commodities such as energy, industrial metals, agriculture, and other inflation-linked inputs depending on which are scoring most favorably under the model at each rebalance. The idea is to target the commodities most likely to reflect changes in real-world prices rather than relying on backward-looking correlations. The index underlying HGER is reconstituted and rebalanced quarterly, allowing the strategy to adapt as inflation drivers evolve. This regular reset helps keep the portfolio aligned with current inflation dynamics while maintaining diversification across commodity sectors. Performance is calculated on a total return basis, meaning returns include not only the price movement of the commodity futures, but also the return generated from managing the fund's cash collateral. This collateral component can contribute meaningfully to returns, especially in higher interest rate environments. Structurally, HGER gains its exposure using excess return swaps, which reference the underlying index. These swaps are held through a wholly owned Cayman Islands subsidiary, a common structure used by commodity ETFs. One important benefit for investors is that this structure allows HGER to avoid issuing K-1 tax forms, making it simpler to hold in taxable accounts compared to some commodity funds. It's also worth noting the fund's history. Prior to March 6, 2023, HGER traded under a different name and tracked a different index. The current strategy reflects an evolution toward a more explicit, CPI-focused inflation hedging approach. From a portfolio construction standpoint, HGER is best viewed as a diversifier or hedge, not a core holding. It may appeal to investors concerned about persistent inflation, currency debasement, or rising input costs who want exposure beyond traditional stocks and bonds. However, commodities can be volatile, and returns may vary significantly depending on the inflation environment and commodity cycles. The bottom line is this: HGER is a rules-based, actively structured commodity ETF designed to hedge inflation by targeting the commodities most sensitive to CPI changes. Its dynamic weighting, flexible gold allocation, and broad commodity exposure make it a differentiated tool for inflation-aware investors. If you found this breakdown helpful, make sure to like the video, subscribe to the ETF Investor, and comment below. Do you use commodities as an inflation hedge, or do you prefer other real asset strategies?